Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in the last few days I have been looking at some of the companies that I own in this portfolio. Like I've always said to you guys, there's about 26, 27 companies, 25 companies in this portfolio in one ETF. And what I would like to do is just in the next few weeks, just go through majority of the companies that I own in this portfolio, just one by one, inshallah. And just some of them I have been talking about for a while. And there are some companies in here that I haven't spoken about for a long time. So what I want to do today is I want to talk about a company called Cummins. But before we do that, please like the video, subscribe to the channel. If you're finding any of the stuff that we're doing here, any value of any sort, please definitely help us the channel by just clicking that like button, subscribe to the channel. Obviously, let us know if you have any questions, as well as joining us on the Patreon account, which gives you access to the Discord. We're trying to build the brothers and sisters who are like-minded, who can help each other, inshallah, moving forward. You got access to the ebook, the Sharia compliant ebook, and loads of different dividend trackers and so on. So the companies that we're talking about today is Cummins. Company is basically in the industrial sector. This company is very well known for producing basically diesel engines. But recently they are actually building in new technologies that will help the basically world go green. And this includes natural gas includes electric and hybrid powered engines. So they have loads of different products. And what I want to show you today is basically talk about some of the basically the fundamental side of the business. Okay, just look at the numbers. So like I said, they develop the engines, they also have generators and power systems and other components as well. They've been around for a very long time. You know, at the beginning they were very well known for producing diesel engines and so on, but now, like I said, they're trying to diversify by basically having natural gas, electric and hybrid powered engines and so on. The other thing they do is they have their own branded engines. So you might find some cars will have their own branded engines, especially like the vans and the trucks and so on. But they also work with other companies like Ford and so on to produce some of the engines for them. So not only do they have their own branded engines, they also produce for other companies. And basically, obviously, that's, to me, that's really good, because if you think about it, they're working with their current basically competitors, as well as also producing their own engines. And if you go to their website, you'll find everything. You'll find the engines. Okay, so there's basically engine solutions, and then you've got generators, you've got the other components, you've got parts and services, you've got the technologies, like I said, basically, and natural gases. You've got natural gas engines, you've got vibrates, and basically there's a lot of more information that you can find out about what the company does, and just basically the prices they charge and that kind of thing. It's not a huge company. I think it's about 30-something billion market cap, so it's actually quite small, but they do have a massive production lines when it comes to all the types of generators, all the types of engines that are available out there. So now what I'm going to do is I'm going to go over the financials, but before I do that, I just want to talk about a couple of things. So recently they released their earnings, so I want to show you that first, and then I'm going to show you something on Morningstar. Then we'll look at the valuations of this company. Now in terms of sales, so I'm going to go down straight. You can see they got components, they got engines, distributions, power systems and so on, and you can see the sales that comes from each basically segment of their business. And right now the total basically for the basically since June and basically the last 3 months, and because they reported in August, that was about $8.6 billion. So they are not basically small company, but it's still basically they are a small company, but they're still producing over $8 billion of revenue per quarter. And basically one of the reasons I actually think this company is worth looking at is basically the fact that they actually have their guidance, and it's about 15 to 20%. So what they're saying is the full year guidance is about will be up basically 15 to 20%, and that's really good, double digits growth for a small business like this. And this is one of the reasons I like this company. It has a predictable kind of income. Now I warn you, one of the things that this company is cyclical. What that means is their business depends on how the economy is doing. Okay, no one is gonna buy new basically trucks and new basically engines from this company if the economy is not doing well. So when the economy is doing really well, and right now especially where the US is actually spending a lot of money on the construction, this company will benefit a lot of that, because they need the tractors, basically the tractors that will move these goods back and forth. So for that reason, this company will do well. But if you look at the the price range, you can see it's been up and down, and the reason is because it's a very cyclical business. So if you buy in this, you might see this company in the red a couple of months, and then next month, next year, it might be up a lot. And the highest it's been basically since in the last 52 weeks is $265 per share. A year to date is actually down about 2%, and for the 1 year it's actually up about 7%, which is quite nice. If you had this company for the last 5 years, you would be at about 65%, and for the last 10 years, we're looking at about 74%. So let's call it 75%. So 75% up on price appreciation, as well as the dividend this company pays, which is what we will look at in a second. Now, like I already said to you, it's industrial. Cummins is the name, $236 per share. EPS about $17.85, and it has a 33 billion market cap, which is quite good. So it's not a huge, it's not a small company either. Economic mode, basically we're looking about narrow right now, and beta is just above 1, so which is not bad at all. The current P of this company is about 13. Okay, and the forward P is about 11, and when you look at the sector, is way cheaper than where the sector is right now, and is actually cheaper than it is 5-year average, which is basically about 14. This basically the S&P 500 right now is about 25. The price free to free cash flow here is about 30, and PEG ratio just below 2, which is fine. Now, dividend yield, we're looking at about 2.85%, payout ratio 33%, which is absolutely fine. Latest increase was 7, and the 5-year growth rate of 7%. So they are growing their dividends actually quite nicely, and they have increased that dividend for 17 years in a row. So another 8 years, in the next 8 years, this will become a dividend aristocrat, which are companies that have increased their dividend 25 years or more. The annual payout is healthy, $6.72. I say healthy because the dividend safety, according to Simply Safe Dividends, about 98%. They have free cash flow of over $1 billion, which is quite nice. And then for a small company like this, and the reason we like to look at free cash flow is because this is the money the company uses to pay off, for example, any debt the company has. They basically use that money to buy back their own shares, and this company actually does buy back their own shares. They can reinvest it in the business. They can acquire other business. This company basically likes to buy other businesses as well to grow their business, which is quite nice. Free cash flow, you will look around about now 3%, which is basically in line with what we're looking for. And free cash flow margin, we're looking at about, normally we look for about 5 or more, but this company has about 3%, which is basically close enough. Profit margin is about 8%, operating margin about basically 11%, and return on equity, we're looking at about 27%, which is quite good. Total return in the last 10 years, we're looking at about 8%. Return on invested capital about 13-14%. And revenue compound annual growth rate in terms of revenue side of things, we're looking at about almost 7% in the last 5 years. Current ratio is above 1, so that means the company has enough basically enough assets they can liquidate if they need to pay off any basically liabilities that they need to cover in the next 12 months. Now, in terms of growth for next year, they're expecting the EPS or earnings per share to grow actually basically to decline about 2%. But then after that, every single year, they're expecting about basically 12% almost growth every year after that, which is quite interesting for a business like this. It's really good. So like we've already seen next quarter, they're expecting, so for the end of the year, they're expecting about basically 15 to 20% growth, which is quite nice for us. Current ratio, basically price, we're looking at about 236, and fair valued basically according to Morningstar valuation is about 7% discount, and $253 per share is what they expect the price to be. Okay, fair valued undervalued according to simply Wall Street, 256, so quite close these two. Okay, so 7%, 8%, 9%, whatever it is. When it comes to tip rank and Seeking Alpha, again 10%. Both of them use the same analyst. For the next 12 months, they're expecting the price to be about 260. Again, another 260. So give or take 200, basically 50 something to 260 is where they expect the price to be. Right now, $235 per share, which is absolutely fine. So give or take, you get you 7% to 10% in the next basically year or so if you were to basically buy it right now at this price. Now, according to Seeking, tip rank is actually a moderate buy, and Seeking Alpha is actually a buy. Sharia compliance side of things, no issues with this company. When it comes to interest bearing debt, a little bit high, but normally 25 or more, that's why I'm considering higher. But right now it's about 23, so it's just fine. Interest bearing securities is about 7%. Now, like I said already, this company buys back their own shares, which is absolutely brilliant for investors, because you're getting closer to 3% dividend yield, okay, as well as that they're buying back their own shares, which is quite good, and the growth is actually quite healthy. This is the type of business I like to own. Not many people know about this company, but I really like this company because they're buying back their own shares, their revenue is growing. So in fact, I'm going to show you the revenue side of it for the last 10 years. And when you look at this, when you look at it from $17 billion, basically you can see, okay, you can see basically 19, there was a bit of decline in 2016, then it bounced back to $20 billion, and then $23 billion, again 23.5. Then 2020 obviously was a bit of a decline because of COVID, I guess, and then basically $4 billion, $28 billion. Right now we're looking at about $32 billion. So it is heading the right direction. It's actually, in terms of revenue, it's growing. In terms of dividends, is good. They're buying back their own shares. The growth is there for for these things. And the other thing I want to show you is the earnings estimates for the next few years. So single digits, nothing to worry about. Nothing. Basically, EPS right now is about 22%. So double digits there. They're expecting this year, but after that, basically they're expecting a 2024 basically it's a little bit decline, and then up 2025 it will bounce back. Now I'm not going to basically bother with these two because there's only one analyst looking at that, but the 8, if that's true, that's actually quite healthy, and that's why probably the average comes from, basically for this average here comes from, so they add together, obviously give you an average when it comes to these things. Same goes for revenue side of it, okay, from $33 billion to let's call it $34 billion. So there's a bit of a decline, and then it bounces back again. So double digits, single digits after that. This is the type of businesses I like to own in my portfolio. Not more than basically 4-5%. But again, it's basically steady Eddie kind of company. You know, the products they have are in demand, and these products are actually sold on every single year, and they make a basically profit on those on top of that. So what I want to do with this company going forward, as you can see here, I own 17 shares. So I'm hoping that will decline maybe another 5% or so. Then I can actually pick up a few shares. I'm happy to buy at this rate, but my issue right now is this. Okay, the all sectors for my portfolio. This is my dividend portfolio right now that we're looking at. Okay, as you can see, information technology is the biggest when it comes to all the sectors, 24%. Industrial is about 23%. Then the next one is healthcare, which is about 14%, and so on. So I'm focusing right now building the healthcare, consumer staples, materials, okay, consumer discretionary, real estate. I want to put this up a little bit. Financials is only 2 companies, that's Visa and S&P and Global. So those 2 companies, I think they might be getting to that basically overvalued territory. So I'm going to leave them for now. But I'm going to build the healthcare, I'm going to build materials as well as the consumer discretion and real estate. So once these maybe become about, I don't know, 12%, 13% and so on, maybe I can look at that. But that 23 basically is going to overtake sooner or later this, because I do own quite a bit of companies. In fact, I can show you. Okay, if you click the industry, you will see basically the companies that I own here are these companies. Okay, Union Pacific. I've got 3M. Probably when I sell 3M, it will actually, things will get better. Maybe once that happens. By the way, I'm not selling soon, okay, because I'm gonna wait for 3M to bounce back, because right now I'm down about 26.5%. So once it bounces back, maybe I will sell it. But there you have it. That's the company that I wanted to talk about today. If you're enjoying this type of content, I want to make sure that basically I'm going to continue doing this, inshallah. All I need from you is just to basically join us on the Discord, join us on the Patreon account, like the video, subscribe to the channel, share it with your family and friends, put the words out there, inshallah. And I'm going to continue doing this as long as I, inshallah, can. Have a wonderful day. Assalamu Alaikum.